Q3FY23 results conference call of Samvardhana Motherson International Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. I now hand the conference over to Mr. Vivek Chand Sehgal. Thank you, and over to you, sir.
Thank you. Ladies and gentlemen, good evening and thank you for joining us this evening. SAMIL board has approved the third quarterly results and we are happy to report another improved performance. We crossed 20,000 crores in a quarter for the first time, best ever quarterly revenues yet, topping our earliest highest during quarter 1 and 2. We generated double-digit growth in EBITDA and profit on Q&Q basis, nearly 5x bottom line on a year-on-year basis. Enabled by improved performance by all divisions despite inflationary headwinds and localized challenges. We reduced the net debt to EBITDA improved from 2 to 1.8. There is still some pain in the system, but the worst seems to be behind us. We're thus cautiously optimistic going ahead. These results demonstrate strong fundamentals of the company and continued focus on operational efficiency. Our teams have worked very hard to deliver this result, and with further improvement expected in business environment, we are poised to deliver greater value to our stakeholders. We want you to thank our customers for their continued trust in Motherson. As always, with me, I have Vaman, the management team comprising of Pankaj, Char, Rajat, and Kunal. With this, I would like to ask Vaman to walk you through the results. Vaman?
Thanks, Papa. Good evening to everyone. The company has reported another set of record results with the highest ever quarterly revenue of over 20,000 crores. This is a 25% growth Y-on-Y and also an 11% growth on a Q-on-Q basis. All business divisions improved performance. Correspondingly, EBITDA grew to 1,680 crores with a 13% growth sequentially and a 45% growth on a Y-on-Y basis. PAT was up 5x versus last year the same quarter and nearly 2x of the previous quarter. With chip shortage and supply chain improving in most parts of the world, production scheduling was much more stable and enabled recovery of volumes on Y-on-Y basis, with industry volumes growing by 2% in light vehicles. All regions grew other than China. As you would expect, COVID-related issues caused China volumes to decline 6% Y-on-Y and 2% Q-on-Q. On quarterly basis, industry volumes for light vehicles were flat in North America, India, and China, all showing decline ranging from 2 to 3%. We were, however, aided by growth coming back in Europe, which showed 15% growth. This highlights the benefits of a diversified business model. On commercial vehicles, there was a 6% decline on Y-on-Y basis, with China being the main contributor, though North America showed 3% growth. On quarterly basis, China improved by 24%, although on a small base. Europe was also up by 18%, but North America was down by 6%, resulting in an aggregate industry volume growth of 5%. You can refer to slide 5 for industry details. Our 25% year-on-year growth highlights significant outperformance versus industry growth of 2%. Even without considering the revenues from erstwhile SAMIL, which were not there in the previous quarter, we grew by over 20% in this quarter versus Q3FY22. Continuing trends on premiumization, electrification, commodity costs, and sharing of inflationary costs, etc., continue to add content and value to our products. This was further fueled by a favorable forex impact. Even on a Q-on-Q basis, we grew by 11% versus a flat industry growth. You could refer to slide 12 for more details on that. We are very grateful to our customers for their continuous trust and support in Motherson. We continue to work with them on sharing of these inflationary cost structures, and we've embedded some of the success in this quarter and continue to work with them to close out the remaining in the coming quarter. Given the continued volatile sales of variables in this world, we expect that this conversation will be a regular feature for some time into the future. On the capex side, we remain vigilant and in line with our guidance we gave last quarter of being at the lower to mid-end range of 2,500 crores, plus minus 250 crores. So somewhere between 2,250 and 2,500. The improved performance and focus on capex has decreased the leverage ratio to 1.8 times versus 2 times in the previous quarter. Net debt actually reduced by about 50 million euros versus previous quarter, although the forex changes had a negative impact of about 350 to 400 crores. We continue to carry elevated working capital levels given it's still early days to China removing the zero COVID policy and the geopolitical situation in EU countries. However, we remain confident that by year end, we should be able to normalize some portion of this working capital. This is also supported by improvement in global supply chain pressure index and some softening of commodity prices. You can see slide 7 for more on this. Given this backdrop, as well as the declining energy costs versus previous quarter, we remain confident of delivering continuous improvement in the ongoing quarter as well. This will enable us to deliver much more going ahead and aid our inorganic plans as well. We thus believe we have adapted ourselves well to the new realities and are cautiously optimistic on the way ahead. With this, I conclude the overview and we now open it for question and answers. Moderator, can you support please?
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The first question is from the line of Kapil Singh from Nomura. Please go ahead.
Good evening, sir. Congratulations on a great performance for the quarter. My question is firstly on European operations. I just wanted to understand that from a revenue run rate perspective, are we closer to the normalized run rates or there is still significant supply chain pressures and therefore we should expect further ramp up in production run rates? And also on inflation, if you could just mention, we've seen person costs and other costs seeing significant cost inflation. So does this quarter fully reflect most of it or should we expect more increases in these line items?
Raman? Sure. I think the production run rate that you talk about, we definitely had some instances starting up post the December holidays, etc. But since there's more talking about the last quarter, we definitely do see an improved trend. However, it's hard to really comment with the ongoing macroeconomic situations in Europe. And we will understand more as we get closer to the summer and understand how things are flattening out. So definitely do see some catch up towards that for the missed run rates that we had in the previous quarters. But it's very much a watch closely kind of a situation. On the inflation side, we believe most of it has already been taken in. Of course, a lot goes to be seen how things pan out the rest of the year. But definitely is a ongoing discussion with the customers to see what's going on. It is a volatile situation that is there, can move in any direction, and I think that's when we are making sure that we have close communication with our customers to be ready for any eventuality. But like I said, we are cautiously optimistic, but definitely not clear of the woods in terms of volatility yet.
Okay, thanks, Vaman. I had two sort of clarifications on the presentation. So one was on slide 16, we have mentioned wiring harness division, where there is a 61 crores favorable outcome on tax litigation. If you adjust for that, actually margins are a bit lower on a QOQ basis despite better revenue. So wanted some color on this. And second is on the standalone results, we see that the other income has seen a significant increase on a quarter-on-quarter basis. So it was 144 crores, it's 248 crores from September to December quarter. So if you could just throw some color here.
Kumar?
Kapil, firstly on the wiring harness side, you're right. You would have seen MSWIL results also yesterday, which had a slight decline. India in general has been in Q3 lower than what was expected. You heard, I'm presuming, enough about the reasons behind it. The fact that production was missed, chips, there were chip shortages still in India, and so on and so forth. So while the capacities, etc., were there, but the production didn't really happen as much. So that is one of the large reasons why it looks the way it looks. On top of it, if you think about China, there was growth, a little bit of growth, but it's still so significantly below previous levels, and the base is so small now in China that it continues to still make losses right now. So these drop the margin profile really in wiring harness. If you look from an other income perspective, the 61 crores that you are referring to, this is actually lying in that other income. And you are also aware that the rental income that SAMIL now charges MSWIL, that is also lying in this other income. But the large difference is on account of the 61 getting booked in other income, and that's why we've highlighted that specifically as well. Going forward, we aim to reclassify some of these things to make it a little bit more clearer, and hopefully next quarter onwards, this will become much more elaborate for you to understand this better.
Okay, thanks.
Thanks.
Thank you. The next question is from the line of Jay Kale from Elara Securities. Please go ahead.
Yeah, thanks for taking my question and congrats on a good set of numbers. My first question, sir, is you mentioned about the strong outperformance to the global industry via revenue growth. If you can just kind of break it down into how much of it is because of your content increase versus inflationary benefits as well as mix. Any flavor for that 11% outperformance? How much of it would be because of content increase?
Raman and Kunal?
Yeah, I can start and Kunal can help. I don't think we've done to that minute detail. As you can imagine, there are numerous new programs running, and there are launches and there are diversified customers. So I think on an overall basis, we do feel that the diversification has helped, where some customers were obviously affected a bit more, some customers affected a bit less. And hence we are not tracking exactly as the market in fact outperforming with the strong order book and the launch. And we had already shown how our content is increasing with the changes in the preference and taste. So I think all of that has helped, but to give you an exact breakdown, I think will be difficult.
Understood. And also on the energy costs, you had called out in the last quarter as well, and that you are in talks, and in this quarter also in presentation you mentioned that you are in talks with customers for getting a pass through for the energy cost rise. So just wanted to understand where are we on those talks? How what % of customers would have given you that energy cost increase? Because if you see your energy cost as a % of sales for say SMRP in this quarter it has moved up on a quarter-on-quarter basis. So we're just wondering, in going forward, are we expecting that in future quarters? And if at all we get that compensation, would it be reduced from other expenses line item, or it will be added to revenues as a compensation?
Yeah, I can start this and the others can support. Again, I think it was a conversation to have with the customers. The energy prices, specifically in Europe, have been quite volatile. Although I think we have seen the past peaks behind us. There was definitely more softening in December and Jan. We definitely did have those conversations with the customers. Again, it depends on the customer, depends on the program, depending on the location. As you can imagine, the energy prices have not stayed stable for all of Europe. Different countries have different impacts. And that's where the support has been spoken to with the customers. And again, it's completely varying depending on the location and the product. That was also only up to the point of December. So in January, again, we have seen some softening compared to where the levels were in December, but still elevated levels as compared to where it is normally. And those discussions, as we mentioned to you before, are a continued path where we will continue to talk to our customers, show them the impact, and hopefully have some support if it is quite large this quarter as well. But the good news is that it's on a negative trend from the peaks that we saw, but still at elevated levels. For the accounting, I'll request Kunal or Ritik to answer the question.
Yeah, so look, I think the numbers obviously elevated in quarter three. The peaks were seen in October, November. Since then, it's on a declining trajectory, though still continues to be volatile. Where we stand right now, and whatever outlook that we have in the current environment, it does seem that energy prices would be lower in the ensuing.
Okay, just to answer, understood. So just to say that since energy prices are actually declining, you may not require those kind of price increases from your customers, which you all were wanting maybe 3, 4, 5 months back, since already it has started on the decline. That would be the right understanding, right? Okay.
Yes, let me just put it this way. Look, this is not the only thing that is under discussion with customers. When you're discussing with them, then you're discussing as a comprehensive package across commodities, across inflationary pressures, across supply chain issues, across working capital issues, and so on and so forth. So it's not necessarily a like-to-like on a single aspect only. So when it is really about sharing the pain. These are not factors that were built by anyone, and hence it's the sharing of aggregate pain.
Fair.
That's how the customer discussions are happening.
Great. Thanks and all the best.
Thanks.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. Next question is from the line of Kumar Rakesh from BNP Paribas. Please go ahead.
Hi, good evening, team. Thank you for taking my question. I had just one question around your customers. So Volkswagen, which reported its pre-release its numbers, did talk about working capital pressure, which they saw especially towards the end of the December quarter in the last few days. And they talked about inventory being stuck of finished goods as well as on the supply side. Do you see some of that impacting your March quarter as some of your customers start rolling out their stuck inventory and possibly the production needed from our side may be lower?
Look, we did see, again, I can't go into customer-wise specifics, and I'm not answering for Volkswagen. I'm just talking in general. We did see some delayed starts from customers. But again, we do hope that catches up. Usually, you do see a more strengthening happening as people are coming out of the December holidays, January holidays. So we definitely do see better pickup in February and March. So look, that's something general that we see. I think it might not have been extra special this year in particular, but like I said, some customers definitely did take some time to clear out some inventories. But that was also because of building up some of the semiconductors, which still continue to play havoc in some programs. So it could also be that they are making sure that the inventory levels are stocked to a good level for more level production till the end of the year. So again, we are optimistic that it should be caught up. But yes, was there some effect of that? We definitely did see that in the Jan start. But hopefully it should be caught up.
Got it. Thanks a lot for that. Just one clarification. Sorry if you have already answered that. How much would be energy as percentage of your cost?
I think it will be ballpark somewhere in the 2.5 to 3.5% levels.
Got it. Thanks a lot, team. That answers.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. Participants, to ask a question, you may press star and 1. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Basudev Banerjee from ICICI Securities. Please go ahead.
Yeah, thanks and congrats for good set of numbers. A couple of questions, sir. One, if I look at your SMP, erstwhile SMP and plastic business margin, which used to be in good days somewhere 8% plus. So now because of various cost inflation items, as Kunal mentioned, plus crude was also elevated at $100 per barrel plus. So it is now down to 5 to 7% level. So how much, just to understand, with crude down to $80 and the polymers which you are using for the plastic product business, so is there any lag effect of input cost of polymers for that business? And with crude at 80, it should help the plastic business margin inch up. How to look at from that angle, sir?
I can take that. Look, we're talking about highly engineered plastics. So while there is a correlation, I don't think it's a direct correlation as you do see it. So even when the oil prices went significantly higher, even though our raw material cost did move up, it's not always in the same 1:1 level, as you can imagine. So definitely, as it's moving down, it eases some of the pressure on us, on our suppliers. But is it an exact reflection of it going down? Not specifically, because these are very specialized engineered plastics. And anyway, we have clauses with the customers that if there is a significant movement, I mean there is a range in which we have to absorb it, or the customer absorbs it. But after that range, there is a discussion to be had with the customers. So like I said, I think most of these quarters we are staying very, very close to the customer, being completely transparent, showing the things that are not in our control, trying to pass on the volatility as much as possible, and getting good support from the customers as well, where it is a reasonable impact. So definitely, like I said, it works both ways for us in discussion with the customers. But should it help? Definitely. What context we'll see, because we'll probably know only once we've seen the entire quarter go through.
Sure. Second question is, which Kunal earlier mentioned, not only with respect to power cost inflation, but freight inflation, wage inflation, working capital, chip cost, everything combinedly on a holistic basis, where you discuss with your customers in terms of price contracts. So on that overall basis, any scope of price renegotiation from a annual contract basis currently as such?
Okay, I can take this as well, Kunal. Maybe you can support. Look, some things which are operational for us definitely have to be observed by us. We are obviously making our own efforts to improve operational efficiencies. Where the costs are out of the control, have spiked for reasons that are out of our control. We definitely do have those conversations with the customers, including volume changes or shift cancellations or anything like that. Like I said, but for like smaller items like logistics, etc., to some point we have to absorb it up to a certain level, which is why you've seen the results where they were in the last few quarters in that tough environment. And as these things are easing and as we are getting support for items that are reasonable enough, I think we are doing better. And I think we should not take away from the operational teams that are working extremely hard to deliver on higher efficiencies in the business, removal of fat, and making sure that we can sustain and keep standing during these tough times and continue to support our customers with the highest quality and delivery even in such conditions. And I think that's what's appreciated by our customer. The rest, I think, again, it's a continuing dialogue that we have with the customers, and we can really, have a very good relationship with them that we can discuss how to deal with some of these things in the next quarters as well.
Sure. And last question from my side. If I look at on a sequential basis, euro terms, revenue was up some 3.5%. In Indian terms, it is higher because of currency movement. But even in a quarter with lesser working days, on a sequential basis, your revenue was up. That's quite commendable. Just wanted to understand the trajectory where SAMIL has been moving for past few years, where better mix, rising EV mix, etc., where value per car has been moving up compared to volume of cars serviced. So how that has been moving, because even on a sequential basis, revenue increase is quite incredible.
Thank you. Thank you very much for that. I think, again, it's commendable to the teams that are winning the new business orders, and we continue to invest in technologies that enable us to increase our value content. We had shown some of that in our investor day, how the future of our business is positively affected by changes in preferences of consumers, whether it be, again, some of the buzzwords that we talk about, or general preferences in the sizes of cars that they want, and the luxury segment also growing. And I think that's a combination of all of that, and having a well-diversified business where we have the opportunity to have launches even in tough conditions, because we are with all the customers and part of their new launches. And we always try to increase the value of the new launches compared to the previous ones. So again, whether it is materials, whether it's processes, whether it is adding more technology, adding more electronic content, adding more features, all of that really goes in, and that's the key reason why we are able to grow even in a depressed market.
If I might add, Vasudev, that's why we keep saying please look at absolute EBITDA. So the first question on looking at polymer 8-9% margin, etc. It'll just be useful to look at absolutes, and hopefully we will continue to do better every quarter.
Sure. Thanks, Kunal. Sounds good.
Thank you. The next question is from the line of Jinesh Gandhi from Motilal Oswal Financial Services Limited. Please go ahead.
Hi. My question pertains to the inflationary pressures on the commodity side. Have we started to see that moderating in our numbers now, or that is yet to translate into our P&L?
Maybe I can help there. We haven't seen it as yet. It is in the process of softening. There is a lead lag effect that happens in there. So like we were talking about energy last quarter, the energy was still elevated. So this is more in the quarter that this will be much more softer. Same supply chain has now started easing. We had anticipated we would be able to normalize our working capital in this quarter, but not much could have been done given just how the geopolitical situation continued and how the COVID-related issues in China continued. So that is also work in progress, and as the supply chain becomes much more stable, the intent is to make this decrease the working capital going forward, which would again help in deleveraging in the ensuing quarters.
Right, but particularly on the input material like copper on the wiring harness or polymers on modules and so on and so forth, have we seen stabilization at least, if not benefits?
Yeah, that would be a better word. It remains volatile. So, copper in last quarter did show in the latter part a decline. Then, in January it started going up. Then now it is again showing a bit of decline. So it remains relatively volatile, but it's not showing a takeoff or a fall down from a cliff construct. So it is more stable, and hence, with a lead lag effect, it should be more of a pass-through element, at least copper for us.
Got it. And second question pertains to the order book which has gone into execution over the last couple of years, which has come out of our order book per se at SMR PBV level. Would it be fair to say that the large part of ramp-up of those orders is still behind? I mean, it's still to happen because of the supply side issues, and as that happens, we should see a good evolution on the top line as well as profits for SMR PBV?
Look, I can take that. Look, it's a continuous process. I think some of our large plants are already up. We are seeing, of course, some new orders also kicking in, which is a continued process. And I think that's also one of the reasons that you're seeing record revenues that have come in this quarter. So is there still more growth to come? I definitely think so. And that's again due to the success of the group being diversified and us launching more programs, and you're seeing a strong order book that exists of new programs that are going to come in the coming quarters. So I definitely think that the best is yet to come.
Got it. Thanks and all the best.
Thank you. The next question is from the line of Jay Kale from Elara Securities. Please go ahead.
Yeah, thanks for taking my question again. Just a follow-up, on your M&A strategy as well as your M&A outlook. How are you seeing the environment currently in terms of target companies? Any flavor you could give on whether the opportunities intensity that you're looking at has increased, and within your different segments like polymer, vision systems, and wiring harness, which are, and of course the other emerging segments of non-autos, which are the segments that you're most excited about, or most number of target companies you all would be looking at? Any indication around that? And also, there was this expectation that with the restructuring, you all could also now look at global passenger vehicle wiring harness opportunities as tier 1 suppliers. How is it shaping up over there in terms of inorganic opportunity?
Wow. Vaman, you want to go for this?
Look, I think the strength of Motherson is, as you can see, that we are significantly deleveraging ourselves and preparing ourselves for growth. We have a very clear target for 2025 that remains intact. In fact, independent teams are working as we speak on multiple opportunities. As you can imagine, in these environments, I think there are even more opportunities on the table. Very hard to say which one I'm most excited about. It's like asking someone who has multiple kids which one is favored out of all of them. We believe there's capability and opportunity in all divisions, and are also very confident that we will find very good opportunity not just in the existing business but also in the new business. You have to be a little bit patient with us. We are assigned NDAs, etc. for any evaluation of any opportunity, not really able to disclose. Also, we are extremely picky because we do have to deliver a high ROAS to our shareholders. So, out of 100 opportunities we see, we probably end up doing 1 or 2. So you can imagine how busy the teams are. They're working overtime. There's a lot of opportunity in the market. We are staying focused where our customers are telling us to look at. Those are some of our priorities. Is there enough in the pipeline? Absolutely. I think there's more than we can all work on at the same time. So we are prioritizing. But again, we'll come back to the market as soon as we have something. We're hearing some smaller bolt-on acquisitions that are happening. We just announced a partnership with Sagas. As you can see, our growth also depends on partnerships. So all of those things are happening. I think again, the next 2 years, with the strength of the balance sheet, the wonderful job the teams are doing, and the customer support, I think you will see that we will have a lot more to come back and talk to you about in coming quarters about the question that you've asked. As far as the wire harness bit that you asked, look, that is always there. We do everything with discussions with our joint venture partner. And there is really no stop for us to go and look at anything as long as we have good communication with all our partners worldwide. So nothing is outside of the cards. And we believe in fostering long-term, full of trust relationships. So again, anything that we will do will be in that philosophy. Papa, you can add if I've missed anything.
No, I think you're right. We have a lot of pain in the system, and that means the customers are asking us time and again to solve the problems. I think you will hear soon enough as will happen. In the worst of the years, the last 2.5 years, we've done 7 acquisitions. So you can be rest assured if things are getting better, then we will have that much more, because we always like to be physically present at the place so that we can see the problems and understand it and then find the right solution for that. So because of COVID, we could not go to many of the places and things like that. So we can be rest assured that we are very much looking forward to this opening up, and we will be in a position to give you good news soon.
Great. Look forward, sir. Thanks and all the best.
Thanks.
Thank you. Participants, to ask a question, you may press star and 1. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Saurabh Deora from Paladin Capital. Please go ahead.
Yeah, hi. So I'm sorry I joined the call late. I was wondering if you talked about the booked business slide. It's not in the presentation for this quarter. It was there in the previous quarter. The waterfall which shows your booked business change over time.
I think we say it every 6 months. So, Kunal, could you answer that, please?
Yeah, that's right. Look, we will disclose it again at the end of next quarter. But needless to say, we continue to gain traction in the business, in all our businesses for that matter.
All right. Thank you very much.
Thank you. Participants, to ask a question, you may press star and 1. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Chirag Shah from Nuvama. Please go ahead.
Yeah, thanks for the opportunity, and sorry for I've joined a little bit late, so if the question has been asked. So first, a housekeeping question, Kunal. Is there anything lumpy or one-off in other expenses in a reporting structure which is doing slightly higher, or it's a normal quarterly thing?
No, so there is a 61 crore write back on the litigation which were done favorably for us. So we didn't back that provision. That's the only one-off that we have highlighted in the KPC.
And even at console level, there is no lumpy impact, right? Which could have been spread over quarters, which has come up suddenly in this quarter kind of thing.
Okay, so other than that, look, energy prices are obviously elevated in this period. Some of the commodity prices / freight costs, etc., remained elevated. So if you're looking at the expense side, that's the reason why they're showing an uptick there.
And how is the trend, especially on the energy cost, and because they have been trending down. So that benefit will be seen on immediate basis or because of the need. So how does it work for us? Or there is a lag over there?
Yes, you will start seeing more of this in the ensuing quarters. There are obviously some long-term contracts in place, some short-term contracts in place, and then there are spot rates. So both the availability of energy and the cost of energy is something we've been monitoring closely. Remained elevated last quarter. I think right now it is relatively soft. If it continues the way it is right now, we should be seeing a much lower energy cost going ahead.
And it would be visible in Q4 itself, or it's more with a lag, and hence in Q1 onwards that it will be visible.
It will start being visible in Q4. If it remains where it is, it will become more starkly evident, let's say, in the ensuing quarters.
Okay, this is helpful. Second question was on the truck demand in general and our positioning over there. So in US and in Europe and even in China for that matter, how should what's the indication coming from OEMs? Because if you look at for example, in US, the Class 8 order book data is all over the place. It goes up very much, it goes down suddenly very much, but the retailers are holding on. Is there any trend change communication coming from the OEMs across the three regions, either on the positive or on the softness side?
Chirag, you want to know the customers' issue?
Yeah, what I'm trying to understand that has customers indicated anything to you, be it US, Europe or China, in terms of significant higher demand or some kind of softening of demand on the truck side for our PKC business?
We can't really say, Pankaj, we've not heard anything from the customer side per se, because our customer is our collaborator.
Yes, but Chirag, when you see US also, there is a huge backlog. The order book is very strong of the truck makers.
Yeah.
So they have the orders which have to be executed, and then you see when they start to book orders and then they don't book more orders. So that's how it continues when you just look at those Class 8 numbers also. And so demand has remained strong so far.
Yeah, because
And in China, the demand is still lower. China is the only market where the commercial vehicle side, the truck side, and the heavy duty side has been much lower over the last year.
Any change of trends in China specifically, or it's still 2 quarters away or you are indicating signs that there could be a sudden uptick in demand in China on the truck and the PKC side I'm referring to?
Once it happens, we'll let you know. So we have been hoping for the last 2 quarters also.
Okay, great. No, this is helpful. Thank you.
Thank you.
But just one comment for better understanding. If China is going to is opening up and all that, obviously the truck demand will go up because it needs tremendous amount of transportation, logistics. Just if it helps you. Thank you. Sorry. Go ahead, please.
Thank you. Participants, to ask a question, you may press star and 1. Reminder to the participants, anyone who wishes to ask a question may press star and 1. As there are no further questions from the participants, I now hand the conference over to Mr. Vivek Chand Sehgal for closing comments. Thank you, and over to you, sir.
Thank you very much for this question and answers. I hope more clarity has come to you. I wish you all the best. And thank you very much.
Thank you. Ladies and gentlemen, on behalf of Samvardhana Motherson International Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.